In today's episode, we'll break down two important stories. In the first one, we'll look at how Ministry of Civil Aviation is thinking of changing the rules of privatizing airports in India. And in the second one, we talk about the sensitive issue of stubble burning and what can be done to address it. Hello and welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and bring you the biggest news in the financial markets in a way that's one level deeper as compared to other news channels. Today is Thursday, 25th June. For the third time, a new batch of Indian airports is about to go up for sale. This is the largest of all three rounds. After all, the third time's a charm, they say. But this round is charming in more ways than one, because unlike the other times, the government seems to be changing its mind about how to sell them. The last time India handed airports to private operators back in 2019, it went out of its way to make the bidding process easy. You didn't need to have ever run an airport before. There was no limit on how many you could win. And instead of haggling over a slice of revenue, bidders simply quoted a flat fee per passenger. The whole point was to pull in as many bidders as possible. It worked arguably too well. Adani Group walked away with all 6 airports on offer, in some cases bidding nearly double its nearest rival. This time though, the rule book looks like it's moving the other way. On the Daily Brief, we've already walked through how India's airport business works. Do check it out for nitty-gritties, but here we'll summarize it to set some context. See, for years, the big airports like Delhi and Mumbai ran on a revenue share model. The private operator handed the government a cut of everything the airport earned. That gave the state a share of the upside, but it squeezed operators hard. When the government is skimming a large chunk of your gross revenue, a debt-heavy business like an airport can struggle to breathe. One former Mumbai operator, GVK Group, eventually had to sell out under the weight of its loans. So the 2019 round switched tack. Bidders competed on a per passenger fee, a fixed amount paid to the Airport Authority of India for every flyer who walks through the doors. It was cleaner to evaluate and more predictable for the government, but it also shifted the risk onto the operator, who now had to wring enough money out of each passenger to justify the fee that they had promised to the Airport Authority. That's the model that has defined the last few years, and that's the context the third round operates in. One caveat runs through this entire story, so it's worth saying plainly upfront. None of this is settled. The proposal for all these changes by the Ministry of Aviation is still working its way through the system. So everything I'll talk about is still subject to change. Now comes the next wave. Under the second national monetization pipeline, civil aviation has been handed a target of 27,500 crores to raise by FY30. A big chunk of that is meant to come from leasing out more airport authority airports. A lease is not a sale though. AAI stays the owner and the airport eventually returns to it. What changes hands is the right to run and develop the airport for a fixed stretch in exchange for a fee to the airport authority. In return, the operator gets to earn from the airport however way it can, be it landing charges, retail, parking, advertising, or even real estate. The first tranche is 11 airports. Unlike the last two rounds, these airports aren't being auctioned one by one. They're being grouped into 5 bundles, each pairing a busier airport with 1 or 2 smaller ones nearby. Varanasi, for instance, is reportedly being clubbed with Kushinagar and Gaya. The logic behind bundling is simple enough. Auction airports individually and every bidder chases the same handful of profitable ones. Nobody really queues up for those sleepy regional airport that barely breaks even. It's not just a theoretical worry. The first time Airport Authority tried to lease out Ahmedabad and Jaipur, the auctions attracted too few takers and had to rerun on gentler terms. And those are still reasonably busy airports. Smaller ones are much harder to sell. The fear is that handing over just the profitable airports to the private sector would leave the airport authority stuck running the unviable ones. Bundling fixes that by force. We've seen the same logic playing out inside airports already. The fees you pay to fly are capped by the regulator, kept deliberately low partly because the airport earns so handsomely from everything around the runway. The flip side is that an operator boxed in on these flying charges leans very hard on the rest of the revenue opportunities. It squeezes its shops and restaurants for every rupee, which is why coffee at airports costs a small fortune. The profitable bits, in other words, are made to carry the unprofitable ones. Bundling is the same idea moved up a level. That may sound neat as a policy, but its financing is a lot messier. A bidder is no longer pricing one airport's future. They're pricing a small portfolio of very different airports in a single bet, each with its own traffic and its own commercial potential. The bundle also somewhat inflates the size of the check, which tends to favor bigger players. This might narrow the field to a few large infrastructure funds and established operators who often bid as one big consortium. That's a slightly awkward outcome when the original intention was to spread airports around. On top of that, once an operator owns a bundle, what stops them from lavishing attention on the big airport that makes money and doing the bare minimum at the small one? The entire purpose of bundling was to get the smaller airports developed, but a bundle can just as easily become a place where the weaker airport is still neglected. If the small airport in a bundle can't pay its own way, somebody has to cover the gap. Either the operator accepts thinner returns, or the airport authority accepts a lower bid, or the cost of running smaller airports resurfaces as higher fees at the busier ones. The second new idea is a cap on concentration, which may partly address the concerns of how the bidding for bundles might work. The proposal being discussed would let a single company win at most 2 bundles, roughly 4 airports, and there's a clever backstop attached. If the same bidder tops the bidding for a third bundle, the runner-up gets a chance to match the price and take it instead. That keeps the auction competitive. The principle behind this is simple. After all, an airport is a natural monopoly. A city can usually support just one. If enough of those together come under a single owner, that's a lot of market power in one entity. This is where Adani comes in, though only as the clearest illustration of what the cap is reacting to. Having swept 6 airports last time in December 2025, the group had said plainly that it plans to bid aggressively for all 11 in the third round. But the cap cut both ways, and the government knows it. Restrict bidding too tightly and you risk scaring off aggressive bids, which means lower premiums and less money raised. Let's not forget that this is the very thing this whole privatization exercise was supposed to do. So the real choice is an uncomfortable one. Is the government willing to collect less in order to build a less concentrated airport market? Then there's a third open question. What will be the winning operator actually pay airport authority? Will it be a per passenger fee of the last round, or a return to revenue sharing, or some hybrid of two? That too is still being weighed. India's 2 newest big airports went opposite ways on this question. Navi Mumbai, which opened in December, runs on a revenue sharing model. The new Noida airport, which began flights in June, runs on a per passenger fee. Perhaps this means that the government still treats this choice case by case rather than as a settled formula. And the two aren't just really accounting trivia because they hand the risk to different people. Under revenue sharing model, when an airport does badly, airport authority and the operator feel it together as the government's cut shrinks alongside the operator's income. Under a per passenger fee, airport authority only cares that a passenger showed up. Whether that passenger then spent freely at the shops or not is entirely operator's problem. So a fee model loads more of the commercial risk onto the operator. In a bundle of airports with very different traffic profiles, that's a much harder bet to price correctly. A cap, if it survives, might stop another single player sweep, but that only changes the shape of the risk rather than actually removing it. The danger this round is less about concentration than the winner's curse. Bundles won at aggressive valuations on hopeful traffic forecasts, the kind of overreach that buried airport operators in debt before. Each fix tends to expose the next flaw because the nature of the asset underneath never actually changes. Airports stay expensive to build, heavily regulated and monopolies by geography. What's genuinely new is that the government is trying to decide how many of those monopolies one company should be allowed to hold before the bidding starts, not after. Now, whether or not this proposal survives would be interesting to watch, especially when the tenders finally start landing. And now, on to the second story for the day. Every October, the same thing happens across North India, primarily in Punjab. Farmers who have just harvested their crop face a problem, which is that the ground is covered in leftover stalks called stubble that must be cleared before the next crop can be sown. They have a 15 to 18-day window to do it, and the fastest and cheapest solution available to them is also the most environmentally damaging one, which is setting the stubble on fire. The smoke from these fires drifts south and east. For about 20 days each year, Farm fires across northwestern India contribute roughly 30 to 35% of Delhi's most harmful air pollution. That's the kind of pollution that causes long-term damage to lungs. Every year, this plays out like clockwork, and every year, there's outrage. But what often gets missed in that outrage is that the government has been trying to fix it for 7 years. That's what a new report by CEEW explores. And these fixes have seemed to work to some extent, but there's a lot of work left to do. This is not a story of one part of society wronging another, but rather a rational response to constraints faced by farmers. And CEEW's analysis reveals that the solution to this cannot entirely be technology driven. In 2018, the central government launched the Crop Residue Management Scheme, a program designed to help farmers deal with the stubble without burning it. The basic idea was to subsidize machines that could clear the stubble without burning, giving farmers a way to get ready for the next sowing cycle in time. These machines handle the stubble in two ways. The first method involves incorporating the straw back into the soil. Machines like Super Seeder chop the leftover stalks and mix them into the earth as the next crop is being sown. Or there's the Happy Seeder, which cuts the straw and leaves it on the surface as a natural cover for soil. The stubble becomes compost for the field, which improves soil without burning everything. The second method involves collecting the straw and sending it off to industries like power plants, paper mills, and packaging companies that use it as a raw material. Machines called balers compress the leftover straw into large bundles that can be picked up and transported. Instead of burning waste, you're basically selling it. Since neither of these machines is cheap, the government subsidized a large portion of the cost for farmers who wanted to buy them. It also set up what are called custom hiring centers, which are local rental depots where farmers who couldn't afford to buy machines could hire them for their fields. The idea was to make the alternative to burning accessible in practice and not just on paper. In 2024-25, Punjab's scheme allocation was 375 crore. The government tracks progress through satellite counted fire incidents, and by that measure, the scheme has delivered real results. Reported burning incidents have been declining since 2022. Though the report adds an important caveat, satellite counts may miss some burning events, especially if farmers shift the timing of when they burn. The decline in reported incidents do matter, but it should not be read as the full picture. This is certainly real progress, but it has now stalled. For many of the farmers who haven't stopped burning, this is no longer only about machines and subsidies. Structural barriers exist. A small farmer's tractor is often not powerful enough to operate a super seeder. The nearest rental depot might be a few kilometers away. Hiring labor costs money, and getting subsidy paperwork processed takes time. All of this has to happen within the 15 to 18-day window before the next crop is sown. For many farmers, burning is simply the fastest, cheapest, and most certain option available. On top of this, Punjab has also run into a behaviour change problem. Farmers may know the alternative exists, but fear, peer pressure, misinformation, and weak communication are still pushing many of them back to burning. CEEW surveyed 102 farmers across 3 Punjab districts and spoke to agriculture officials across the state. The results of the survey reveal some interesting attitudes towards stubble burning problem that reveal how much is lacking on the marketing side of things. Firstly, 31% of farmers fall into what the report calls partial burner category. These are not farmers who have refused to engage with the program, but those who are already using the machines. They rent equipment, incorporate part of their stubble into the soil, and then oddly burn the rest of the field anyway. The most common reason cited by farmers who still burn either partially or completely is the fear of pest attacks. The belief is that when you don't burn the stubble and instead leave it in the field or mix it into the soil, pests breed in it and attack the next crop, destroying the yield. But this fear may not wholly be based on experience. Most of the surveyed farmers admitted when asked that they had never personally witnessed a pest attack after switching to machines instead of burning. The fear travels through informal channels farmers trust the most, which is neighbors, village conversations, peer networks, and the same digital platforms where farmers already receive their agriculture information. This is a classic case of Chinese whispers. A neighbor has a bad harvest and blames the new method. That story gets told at the local tea stall and then forwarded on WhatsApp. By the time it reaches the farmer 2 villages away, it has become everyone who stopped burning had their crop destroyed by pests. A government pamphlet about soil health has little chance against that misinformation. These farmers are also closest to making the full switch to the machines. They have already overcome the hardest barrier. They are using the machines. They just need specific, credible reassurance that the pest fear isn't real. But the government's current communication makes no distinction between a farmer who has never touched a machine and a farmer who is most of the way there. Everyone gets the same generic "don't burn" message. The report found that the farmers naturally care most about yield and soil health when making decisions about their fields. But the current messaging of this whole scheme focuses on pollution and penalties. Those are not the same thing. Now, 90% of surveyed farmers said they personally disapprove of burning, and 95% said they believe government officials disapprove of it. And yet, 73% said they regularly watch their neighbors burning their fields. One way to understand this dissonance is to take into account how people make their decisions under pressure. On one hand, there's what they believe is right. On the other, there's what they observe as normal around them. Usually, the visible behavior of the people around you tends to win out. During harvest season, when a farmer is under time pressure and the fields around them are visibly on fire, what they see around them feels like the real rule, regardless of what they privately believe. Each burning field is a signal to everyone nearby that this is the norm of the world around them. This is why more information doesn't fix it. The farmer already knows burning is bad. What they need to see is proof of concept. Showing farmers that others in the village have switched through local success stories and public recognition of farmers who stopped could do more to shift behavior than just a national campaign. But that also creates a chicken and egg situation. If everyone is thinking this and not resorting to better solutions, there aren't enough success cases to showcase. Who then bears the burden of jumping over the cold start problem? Now, the government's current approach to the behavioral problem is awareness campaigns, wall paintings in villages, pamphlets, camps, and TV jingles. The idea is that if farmers are given enough information, they will change. But only 1.3% of Punjab's 375 crore allocation in 2024-25 was set aside for communication activities. The rest went to machines and infrastructure. Even within that allocation, the spending is pointed in misguided directions. The government spent 1 crore painting anti-burning messages on village walls and only 30 lakh on field demonstrations, sessions where farmers get to physically operate the machines and see how they work. Wall paintings got 3 times the budget of hands-on learning. Meanwhile, there is zero allocated budget for social media or WhatsApp outreach, even though over half of surveyed farmers said they receive information through both of these channels. To make it easier for farmers to rent machines, Punjab built a mobile app called Unnat Kisan, a booking platform where farmers could find available machines near them and reserve them for their fields. Of the farmers surveyed, 86% had never heard of it. In fact, a separate CEEW study found that at many of these custom hiring centers that own the machines and are supposed to be listing them on the app, only a small fraction was even aware that the app existed. The platform built to connect farmers to the machines was unknown to both sides of the transaction. Beyond spend though, the government also gets the timing of the messaging very wrong. A majority of surveyed farmers say they never receive relevant information at the time they actually need it, that the window is August to September when the harvest is still weeks away and farmers have time to plan. Now you see, this is not really a small coordination failure. It means that the government's digital infrastructure for solving this problem is invisible to the people it was built for. Farmers who want to rent machines are still doing it informally by calling someone they know or asking a neighbor. Among farmers who do rent machines, the survey found that most of them get them from other farmers directly rather than from official depots. India's current awareness campaigns are built on a single assumption: give farmers enough information and they will act on it. But information doesn't get them across the finish line when fear, social pressure, and habit are pulling them in the other direction. The farmers still burning may know about and align with the objectives of the scheme in principle, but what's missing is communication designed to address the specific reasons farmers are still burning. The pest fear that spreads through WhatsApp faster than any government advisory. The report points to Swachh Bharat as a proof that India has done behavior change at scale before. Building toilets was only one part of the mission. Getting people to use them required repeated messaging, trusted local messengers, social pressure, and visible proof that the norm was shifting. Independent surveys found that roughly 93% of the household ended up with access to toilets, and 97% of those were actually using them. Similarly, stubble burning needs that solution. And finally, on to the tidbits for the day. First up, the government notified coal exchange rules requiring 50 crore minimum net worth for exchanges, capping the single member equity at 5%, with MCX and NSE already approved by SEBI to launch coal exchanges, ending CIL's administered pricing dominance. Next up, Akasa Air narrowed operating losses in FY26 despite 30% capacity growth to 37 aircraft with EBITDA positive for 6 consecutive months. CFO Ankur Goel outlined 30-40% annual growth targets and an IPO timeline of 2 to 4 years. And finally, under the 1500 crore National Critical Mineral Mission Recycling Scheme, commitments from 58 approved recyclers reached 850 kilotons against a 270 kiloton target, with India aiming for 3 lakh ton of annual e-waste recycling capacity by 2030. And that's it for today. We'll see you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.